VIP John AG here. Multiple silver dealers across North America are now reporting zero inventory on key products, not low inventory, not limited availability, zero. As in, you call, you click, you try to buy, and there is nothing there. Wholesalers are telling retailers there are no Silver Eagles available for immediate delivery, no 10-ounce bars from major refiners, no 100-ounce bars from several of the biggest names in the industry. And the premiums on what little remains are exploding past 15, 18, even 20% above spot. Meanwhile, the paper price of silver is sitting around $33 an ounce, and CNBC is telling you everything is fine. I am going to walk you through exactly what is happening right now, why this disconnect between the paper market and the physical market is reaching a breaking point, and what it means for every single person watching this video. This is not a drill. This is not hype. This is documented, verifiable data, and it demands your attention. Let me set the stage with the numbers, because that is what we do on this channel. We do not deal in rumors. We deal in data. Silver is trading right around $33 per ounce on the COMEX. Gold is sitting near $3,300 an ounce, hovering in that range and consolidating after its massive run. The gold to silver ratio is still sitting above 100 to 1. Let me say that again. It takes over 100 ounces of silver to buy a single ounce of gold right now. The historical average is somewhere between 50 and 60 to 1. The modern average, even being generous, sits around 70 to 1. At 100 to 1, silver is either the most undervalued monetary metal on the planet or gold is wildly overpriced. And given that central banks around the world purchased over 1,000 metric tons of gold last year alone and are on pace to match or exceed that this year, I do not think gold is the problem in that equation. Silver is being left behind by the paper market while the physical market is screaming a completely different story. Now let us talk about COMEX because that is where the paper price is determined, and that is where the manipulation lives. COMEX registered silver inventory, the silver that is actually available for delivery against futures contracts, has been in a slow, grinding decline for years. We are now looking at registered silver levels that are hovering around 35 to 40 million ounces. That sounds like a lot until you realize that a single large institution could drain that in a matter of days with delivery requests. Total COMEX silver vaults, which include the eligible category, the silver that is stored there but not offered for delivery, sit around roughly 280 to 290 million ounces. But here is the critical detail. Eligible silver belongs to someone. It is not available for you or me or JP Morgan to grab just because it is sitting in a vault. The only number that matters for the paper contract settlement game is the registered number, and that number has been bleeding out consistently. On the Shanghai side, the Shanghai Futures Exchange and the Shanghai Gold Exchange have been showing persistent premiums on both gold and silver over the Western COMEX price. The Shanghai silver premium has been fluctuating, but we have seen periods where Shanghai silver trades at a meaningful premium of 50 cents to over $1 per ounce compared to COMEX. On the gold side, the Shanghai premium over London has been even more notable, sometimes reaching $40 to $60 per ounce. What does that tell you? It tells you that in the East, where they actually take physical delivery, where the metal changes hands, buyers are willing to pay more than the Western paper price suggests. That is a market signaling physical tightness. That is not a market that agrees with the COMEX price discovery mechanism. Now let me connect this to what is happening at the dealer level, because this is where it gets real for the average person trying to protect their wealth. I have been tracking reports from multiple major dealers across the United States and Canada. Several of the largest online dealers are showing out-of-stock notices on American Silver Eagles, Canadian Silver Maple Leafs, and popular 10-ounce bar products from refiners like Pamp Suisse, Valcambi, and even the Royal Canadian Mint. This is not some tiny coin shop in the middle of nowhere running low. These are the biggest distributors in the industry. When they run dry, something fundamental has shifted in the supply-demand dynamic. Premiums on available products are telling the real story. A 1-ounce American Silver Eagle, when you can find one, is carrying a premium of $8 to $12 above spot. That means you are paying $43 to $45 For a coin that the paper market says should be worth $33, that is a 30 to 36% premium. On generic rounds and bars, premiums are typically lower, around $3 to $5 over spot. But even those are climbing as inventory tightens. And here is the thing that should make every stacker pay attention. The United States Mint has been unable to keep up with demand for years. They have production constraints, blank supply issues, and their output of silver eagles has been significantly below historical highs. We are looking at annual production numbers that are well below the 20 or 30 million ounces per year they were putting out during peak demand years. The mint is not keeping up. The refiners are not keeping up, and demand is accelerating. The Silver Institute's data is crystal clear on this. The global silver market has been in a structural supply deficit for 4 consecutive years. In the most recent full-year data, the deficit was around 180 to 200 million ounces. That means the world consumed nearly 200 million ounces more silver than it mined and recycled. Where did that silver come from? It came from above-ground inventories. It came from ETFs being drained. It came from COMEX vaults slowly bleeding. And now, those sources are running thin. Looking at the numbers, about 75% of you watching are not subscribed. If this kind of unfiltered, data-driven analysis is cutting through the noise and giving you clarity in a market full of confusion and manipulation, hit subscribe. That is how we grow a community built on truth, not hype. Drop VIP, John AG in the comments so I know you are part of the crew. If this content is not for you, no hard feelings whatsoever. I do not chase empty metrics. I do not sell signals. I do not sell mentorships. I do not sell courses. I give you the data. I give you the analysis, and I let you make your own decisions. That is it. That is the model. Now let us get back to the numbers. Here is what makes this truly insane, and here is the smoking gun that mainstream financial media will not touch. While physical silver is vanishing from dealer shelves, while premiums are exploding, while the Shanghai market is paying more than the COMEX price, the paper market continues to operate as if none of this is happening. And the reason is simple. The paper market is not a physical market. It is a derivatives market. For every ounce of physical silver that exists in COMEX registered vaults, there are multiple paper claims against it. The exact ratio fluctuates, but estimates from independent analysts put the paper to physical ratio anywhere from 100 to 1 all the way up to 350 to 1, depending on how you calculate open interest versus registered silver. Let that sink in. For every single real ounce of silver sitting in a COMEX vault marked for delivery, there could be over 100 contracts claiming ownership of that same ounce. The system works perfectly as long as nobody actually asks for their silver. The moment a critical mass of contract holders say deliver my metal instead of rolling their contracts forward or settling in cash, the entire house of cards comes apart. And here is the part they do not want you to see. There have been increasing reports of COMEX delivery delays and unusual settlement patterns. Large warrant cancellations have been popping up, which means silver that was previously registered for delivery is being pulled out and reclassified or removed entirely. When you see registered silver declining and warrant cancellations increasing simultaneously, that is a vault under stress. That is the system struggling to maintain the illusion of adequate supply while the real metal is being pulled out by those who understand what is coming. As I said in the previous video, the smart money does not wait for the crowd. The smart money acts while the crowd is still debating. And right now, the smart money is taking delivery and clearing dealer shelves. Connect the dots. Let me be crystal clear about the physical versus paper divergence because this is the central thesis of everything we cover on this channel. The paper market tells you silver is worth $33. The physical market tells you it costs $43 to $45 if you can even find it. That is a 30 to 36% gap between fiction and reality. The Shanghai market tells you silver is worth more than the COMEX says. The dealer market tells you silver is vanishing from shelves at a rate that suggests exponential demand growth. The mining data tells you we are not producing enough. The industrial data tells you demand is only going to increase. Solar panel installations are projected to consume over 200 million ounces of silver annually within the next couple of years. Electric vehicle production requires silver for every single electrical connection in the vehicle. AI data centers, which are being built at a frantic pace by every major tech company, require enormous amounts of silver for their server connections, thermal management, and electrical systems. Defense applications, from missiles to communications equipment to radar systems, all consume silver. And here's the kicker. None of this industrial silver is recycled at meaningful rates. It is used in such small quantities per unit that it is economically unviable to recover. It is gone, consumed, destroyed. Every solar panel, every EV, every AI server, every missile, it all permanently removes silver from the above-ground supply. The paper market is pretending this reality does not exist, but the physical market knows, the dealers know, the refiners know, the mints know, and increasingly, the stackers know. Now let me address the bearish case head-on because balance matters, and I refuse to be a one-sided hype machine. That is not what this channel is about. The bearish case for silver in the short term is real and you need to understand it. First, margin hikes. The CME Group, which operates COMEX, has a history of raising margin requirements on silver futures during periods of rapid price appreciation. They did it in 2011 when silver was approaching $50. They can do it again. Higher margins force leveraged traders to liquidate positions, which creates cascading sell pressure on the paper price. If silver starts to run, expect margin hikes. It is practically guaranteed. Second, a liquidity crisis in broader markets could temporarily crush silver. If the stock market has a significant correction, if there is a credit event, if something breaks in the bond market, you could see forced selling across all asset classes, including precious metals. We saw this happen during the initial shock phase of major market sell-offs. Everything gets sold for cash. Silver is not immune to that. Third, the dollar could strengthen temporarily on a flight to safety trade if global markets panic. A stronger dollar puts downward pressure on dollar-denominated commodities, including silver. Fourth, and I want to be honest about this, the manipulation can continue longer than any of us expect. The bullion banks have deep pockets. They have regulatory cover. They have the full support of institutions that benefit from suppressed precious metals prices. Could they smash silver back to $28 or even $26 in a coordinated paper attack? Absolutely they could. And if you are leveraged or overextended, that kind of move could wipe you out. That is why I always say, never invest money you cannot afford to lose, and never use leverage in this market unless you fully understand the risks. But here is the bullish case, and I believe it is overwhelmingly stronger than the bearish case when you look at the fundamental data. First, J.P. Morgan Chase, the largest bullion bank on the planet, has accumulated one of the largest physical silver positions in recorded history over the past decade. Estimates from analysts like Ted Butler have put their holdings at potentially 500 million to over 700 million ounces. Why would the most powerful bank in the world quietly accumulate the largest silver hoard since the Hunt brothers if they thought silver was going to stay at $30? They would not. They know exactly what silver is worth. They have been accumulating while suppressing the price, and they will be the biggest beneficiaries when the price is finally allowed to reflect reality. Second, central banks are buying gold at a record pace, and several nations, particularly in the BRICS alliance, are actively discussing commodity-backed currency alternatives to the dollar. Russia, China, India, Iran, Saudi Arabia, the United Arab Emirates, and a growing list of nations are diversifying away from dollar reserves. If any form of commodity-backed trade settlement emerges, silver as both a monetary and industrial metal becomes exponentially more valuable. Third, the supply deficit is structural, not cyclical. There are no major new silver mines coming online that would significantly increase global production. The average lead time from discovery to production for a new mine is 7 to 15 years. Even if silver hits $50 or $60 and makes marginal deposits economic, that new supply is a decade away. Meanwhile, demand is increasing every single year, driven by the green energy transition, electronics, AI, and defense spending. The deficit is going to get worse before it gets better. Fourth, the historical precedent. Silver has made explosive moves before when physical supply tightened beyond the paper market's ability to suppress it. In 1979 and 80, silver went from $5 to $50. In 2010 and 11, silver went from $18 to nearly $50. The setup right now, with 4 consecutive years of deficit, declining COMEX inventories, dealer shelves going bare, and industrial demand at all-time highs, is arguably stronger than either of those previous runs. And fifth, Bitcoin is currently trading around $108,000 to $111,000 per coin. That is relevant because it shows that alternative stores of value are being bid up aggressively. Money is flowing out of the traditional financial system and into assets that cannot be printed or debased. Silver, with 5,000 years of monetary history, a critical role in modern technology, and a price that is still 93% below its inflation-adjusted all-time high, is arguably the most asymmetric trade in any market right now. 3 key takeaways, and we are out. Number 1. The physical silver market and the paper silver market are telling 2 completely different stories. Dealers are running out of product. Premiums are at extreme levels. Shanghai is paying more than COMEX. The paper price does not reflect the reality of physical supply and demand. When you see that kind of divergence, history tells you the paper price eventually catches up to reality, not the other way around. Number 2. The structural supply deficit is not going away. 4 consecutive years of consuming more silver than we produce, combined with exploding industrial demand from solar, EVs, AI, and defense, means above-ground inventories are being depleted at an accelerating rate. The silver that is being consumed by industry is gone forever. It is not coming back, and new mine supply is years away, even under the most optimistic scenarios. Number 3. Panic buying has begun, and most people do not even know it yet. The dealers are seeing it. The wholesalers are seeing it. The mints are seeing it. But mainstream media is not reporting it because a rush into physical silver is the last thing the paper market managers want the public to know about. By the time CNBC covers this story, the shelves will have been empty for weeks and the premiums will be double what they are today. If you have been watching this channel, you already knew this was coming. The data has been pointing here for months. The unresolved tension is this. How long can a paper market that is leveraged hundreds to one continue to set the price for a physical commodity that is vanishing from shelves and running a structural deficit of nearly 200 million ounces per year? At what point does the physical market break free from the paper market entirely? That is the question that keeps me up at night. And it should keep you thinking too. Do your own due diligence. Understand the risks. Be accountable for your own decisions. Nothing I say on this channel constitutes financial advice. I am sharing my analysis, my research, and my perspective. What you do with it is entirely your responsibility. Invest with logic, not hype. VIP out.